702.
You're listening to the best of The Money Show.
The Money Show.
Welcome to the best bits of The Money Show. You're listening to a digest of just some of the best interviews from the show this week. If you'd like to hear more, please go to our website or your podcast app and search for The Money Show. Obviously, a good idea to share it with someone in your life, in your community, maybe in your workplace who you think could benefit from one of the conversations that you hear. To start, some of the news stories that we thought were interesting from the week that was. In a striking show of nearly global unity, the G20 clinching a joint declaration that's despite the US boycott, it did seem to signal to me, and I was there, it seemed to signal the world's intention to move forward without the Trump administration, and certainly was a very powerful moment for President Cyril Ramaphosa. And then, on his own social media platform, Truth Social, Trump said that South Africa is off the guest list for next year. He says, because, and he's lying here, of what's happening to our farmers, our white farmers, he believes that South Africa should not be invited. We'll see how the rest of the G20 feel about that. And then the other big story this week, the Durban Container Terminal seems to now be overhauling operations from cranes to clearances and is slowly but surely working its way off the bottom of being the worst port in the World Bank Port Index ratings. Tonight we bring you a mixture of stories from the world of money from the week that has been. Our shapeshifter this week, Thembani Bukula, the chair of the National Energy Regulator of South Africa. He's an electrical engineer and an energy strategist. He's been involved in regulatory and technical issues for many years and finds himself in the middle of a very interesting situation regarding the energy transition. Thembani Bukula.
So I did my BSc in electrical engineering at the University of Natal. Further to that, I did my diploma in engineering business management at the Warwick University and my master's in maths engineering and science at UNISA. So I was keen on the electrical supply industry.
What was it about it that was so interesting? And I can imagine the technical nature of it. I think you can sort of drown yourself in it. It must be quite interesting. Was it that? Was there something else about, making electrons move that you found interesting?
I think let's start from the fact that I come from a small village called Kofimvaba, and in that village, electricity was not something that we had a lot of. So I think my interest was in knowing about this commodity that makes life easy, and yet it is not so easily available.
And it must have had such a huge impact on your community when there was electricity available. And I mean, it was one of the parts of the country that had to wait quite a long time.
Yes, it did. And I think it changed a lot of lives. I mean, people no longer had to take a bus every day to just go and buy meat that they must consume that evening. And then the following day they have to go and buy. They could now store meat, reduce their cost. So the quality of life, just by providing electricity, improved. I mean, kids could play at night and study. Those who were studying under proper lighting, not the candlelight or paraffin lamp. So it was a big contributor to the change in the quality of life of the people.
One of your first jobs was at a company called Yelland Engineering, and I smiled slightly because there's a Yelland you probably have to deal with quite often nowadays.
Yes, it was actually his family business. His dad was my boss at Yelland Engineering.
Oh, wow. I didn't know that. Geez, so you have a long association with the family then. Geesh.
Yes.
So when I first started reporting on you, and I can't remember the exact year, but it would have been after the first bout of load shedding in 2008, and you were the member for electricity at NERSA for a long time, and that meant you were the person in charge of that. And that's quite you kind of would have found yourself as in the spotlight because so many things were happening around it. How did you end up in that position? How did you end up as a regulator, I suppose, is what I'm really asking.
Stephen, I think my first contact with the National Energy Regulator was when I wanted to do technical audits for them for a few of the transmission lines and substations that they wanted to look at. And out of that, I think they were appointing the first board of the National Energy Regulators, we know it NASA, and it was out of that interaction with NASA that they then nominated me to be appointed as the regulator member that would be primarily responsible for electricity.
How did you find the job? I mean, it's very technical. We sort of would see that person in the context of making decisions about power prices. It's a complex formula. I often wonder, I mean, you must spend hours at night just assessing all of the numbers to get it right. It's very kind of fiddly. It must be very interesting as well.
It is. I think there's the part that is really the science and the accounting and the economics, but there's also then the other part that is more of an art. I think as much as regulation, we may want to look at it as that you look at a lot of numbers and a lot of graphs, and but there's a part where you also, because you are predicting things that are going to happen in the future that you also don't have 100% certainty around them. You also have an art of how do I make sure that even if the future I'm picturing is not exactly what it's going to be, but it doesn't fall far off from that. But I also have to say that during the times of load shedding, as much as there were many other things that were predicted that would happen, when they happened at a pace that was much faster than what we had anticipated, and we also had a utility that was also not operating at optimal levels. So things got really complicated.
Yeah, I mean, very difficult as well. And I imagine there must have been moments where it was probably quite uncomfortable. If we can, I'd like to talk a little bit about sort of the changes we're seeing now. So there's a review around how we put together the electricity price. That's kind of out of your hands in a way. You regulate on what you're given to regulate. But how do you see your role in all of that? Because, I mean, I imagine for me, it would be kind of foolish to do a whole review without including NERSA in it somewhere. And yet your job is to be independent and to basically make a judgment on what you're asked to make a judgment on. I mean, you're a bit like a judge. This is the law. You have to follow that.
Stephen, the matter of pricing, as I said, that I mean, there's accounting, there's economics, and there's engineering in it. And when you have to determine the pricing, you have to consider all of those fields. And in what we are going to do now that we are moving towards the market, what is being hoped would happen is that when we have other players that want to sell their product, the tendency when a market is created is that producers try and find the least possible way of producing their product, which then result in the least possible cost of the product. What our function is going to be going forward as a regulator is to ensure that the playing fields are leveled. We do not necessarily have an entity that has the advantage over the other. Unfortunately, in our case in South Africa, we're still going to have Eskom being a dominant player for at least the next 10 years. So our function is still going to be that one of mitigating that dominance or dominant power of Eskom and ensuring that the other players that are not dominant are given the same rules to play under, the same field and the same parameters to operate under.
So just to be clear, you do believe, I mean, I believe this, you do believe that the introduction of competition will bring electricity prices down. It will make electricity prices lower at some point.
It should, Stephen. When we get to a point where there's efficiencies in the way that you run your operations, then there is no reason why the electricity prices would not go down. We also have a change in the technologies that are being used that also will contribute to the reduction in the cost and therefore make the electricity prices kind of reduce from the levels that we're seeing.
So, I mean, there might be a moment where Eskom, for various reasons, maybe because it's such a big coal-fired producer of power, just can't compete with other operators. Do you have to take that into account, that we do kind of need Eskom or something like it, even if it may just never be able to really compete on price? I mean, that's quite a difficult situation to have to deal with, where you kind of need it as a I don't know, an emergency or a baseload supplier or something. And yet other newer plants may just be able to provide electricity more cheaply. I mean, you need to keep Eskom going in that circumstance, and yet it won't be competitive.
That's partly true that we have to keep Eskom there going, but I think one of the reasons why we will keep Eskom going is because we also haven't got to a stage where the alternative technologies are able to supply power 24/7. The sun only shines during the day, the wind blows when it wants to blow, and therefore you need something that can then provide that base power for when there's no wind and when there's no sun. And I think that's the advantage that Eskom has. The disadvantage with the plants that they have is that they are not the sort of plants that you can, turn on and off, and when you need them, you need to be running them all of the time for them to be able to produce power. It's not like you can, to start a coal-fired power station takes a few hours, and therefore we have to accept that there is going to be that part of the inefficiency in our system if we want to have continuous power available. But I think as the technologies change and as the Eskom improves its own technologies, I'm sure we will get to a point where we have a way of adjusting the output of the coal-fired power stations to align with what is required and not to just have them idling because you can't switch them off.
I want to ask you to make a prediction about power prices and when they'll come down. And as I do it, I realize that this cannot be this will be more of the art you spoke about rather than a science. Do you have any idea of when that might happen? You may not even be able to answer because of the position you hold as chair of NERSA, but do you think in 10 years, for example, we will stop having such big power price increases, or maybe 15 years? I won't hold you to it either way because I realize it's an impossible question.
Stephen, I think as the regulator, we've made this pronouncement, so I'm not speaking out of terms, and I think even Eskom itself has made this realization that gone are the times and the days where we would have increases that are double digits. The increases that we're going to have in electricity have to be related to inflation and the single digit, and there's less the part where we also had to add a percentage or two. If you looked at the determinations, they're already indicating that the increases are going to be in your 5-6% range. And yes, the other part that there is that your other technologies like your your solar PV and wind have had the reduced costs. So there may be periods within the next 2-3 years, periods where we would have cheap power. Say during the day, we would have cheaper power because it is cheaply produced or produced at the lowest cost by your solar PV plants, and then yes, you may have it at higher rates when the sun sets, and you have to start kicking in the Eskom generators and the diesel generators. But we will have that, and other countries have already experienced that. In Australia, for instance, during the day, consumers are encouraged to do anything and everything they need to do with power and pay nothing for that power that they use during the day because of this advantage that has been brought by your solar PV systems with the lowest cost production.
Our shapeshifter this week, Thembani Bukula, bringing a wealth of experience and knowledge from his decades to come and explain what's happening around NERSA.
The best of the Money Show
on 702.
Personal finance this week, Warren Ingram, the financial advisor, co-founder of Galileo Capital, speaking about how you and investors can seize opportunities as South Africa enters a period of economic optimism.
And I don't think we necessarily stop and take stock of, we've arrived here, can we remind ourselves where we were and what we were not complaining about, but what were we worried about 1, 3, 5, 7 years ago? And I'm just thinking, when last did you sit around the braai or the dinner table complaining about load shedding? We don't do it anymore. And the unemployment rates is rising, and the economy is not doing anything, and the country is being badly managed, etc., etc. And we're ingrained to do that anyway, but we should stop and just take a second to look where we are. And for me, a couple of things happened. We gave it attention. We've given it actually attention on this show, but I'm not sure as a country we gave it enough attention. And so things like getting off the grey list. I mean, I've had so many people say to me, oh, well, we shouldn't have been on it in the first place. Of course, that's true. But we're off it. And we did it not necessarily in record time, but actually one of the quickest turnarounds. And then you add to the fact that we're starting to balance the books as a country. You know, when you talk about an individual and you say, please stop spending more than you earn every month. Well, we were doing that very successfully as a country. We were spending a lot more than we were earning. We actually now are spending less than we're earning when you ignore the interest cost. When you add the interest cost, it's not such a pretty picture. But that's called a primary surplus. We're making a primary surplus again, so it's now the second time, and I think we're on track to do it for the third time. Then we get to this blessed budget. And firstly, the budget goes through without a fight.
Yeah.
It happened. If there was fighting, you and I didn't hear about it. It wasn't splashed all over the news. Maybe you heard about it. I didn't hear about it. Seems to me largely a consensus, like that actually our government is pulling in a direction, and it's what I would call a responsible direction. Again, we're spending less than we're earning. We're allocating money correctly, more so as time goes on. And we add into something into that budget of, by the way, we actually think this 3% inflation target is a good thing. Almost like a by-the-by thing. You know,
Yes.
There was a bit of a spat, and now there's not. Then we get Standard & Poor's saying, oh, we think you're doing a really good job. Actually, we're going to upgrade you. So we're still below junk, but we're going to upgrade you. And we think that the momentum for that upgrade is positive. In other words, there is room for more upgrades in the very near future. All of this has happened in a reasonably short space of time. All of it is incredibly positive.
It's also all about momentum, right? It's not about the numbers. It's about the trend, the direction that you're moving in.
Yeah, I think I couldn't remember if I mentioned about unemployment. Unemployment is slightly less bad.
Yeah.
Another positive thing. So what we've got now is that kind of stone that's rolling down the hill. All that's happened is it's fractionally moved. It's got momentum. And what we need to know is momentum has worked against us for a very long period of time. Almost kind of 2007 was the last time we had really good economic news. Now we're having it again. And if you just keep doing the right things, that momentum starts to build. And I think that's where we are now. And it's not just you and I looking at this and going, oh, that's okay. The rest of the world looks at that and goes, the ratings agencies, they're not the most exciting people, right? Like, they're not there looking at the positive outcome. They're looking at what could go wrong. And they're saying, we're doing things well. Things are going well and should carry on. That, for me, is very good news.
There's a big issue around the rand and the new inflation target of 3%. Why is that so important? Because it keeps the rand at a certain level and basically keeps it stronger?
It does. Just to be clear, like the intent is not to manage the rand.
Yeah.
The intent is the country and the people that manage the books of our country, so the Reserve Bank and our Treasury, are saying we are showing the world that we are fiscally disciplined, that we are actually restrained in our spending, and that we can control inflation. If we do that, one of the things that causes the rand to get weaker against the dollar, for example, is if our inflation rate has been 6% for a long period of time, and theirs has been 2% for a long period of time, that difference, that 4% difference will be the amount that the rand will weaken against the dollar. When you ignore all the politics and all the other things that could go wrong, that would be a guarantee. So if we get to 3% and they seem to be struggling to break 3%, that means we're both at 3%. That's one thing that keeps the rand at a level to the dollar. We'll still weaken because we're a small economy, politics are not great and all those things. But a strong rand means we don't import inflation with oil, with food, and that's a big issue. So we import a lot of petrol. We don't have our own. And we import a lot of food, surprisingly. And those things cause inflation. So if you're paying in dollars for those things and the rand is now stable against the dollar, you don't have as much inflation. Again, positive news.
Okay, it's 18 minutes now to 8 the time. You know the number, 011 883 0702, 021 446 0567, and voice notes on 072 702 1702. Your questions for Warren Ingram tonight. That's all the good news that's happening. How you make money from it. And the first thing, I just want to check this, Warren, because I know you'll know the answer. We are now going to have lower inflation, which I presume means that over time, so if we say over the next 20 years, we should have lower interest rates, which I'm hoping means that I would pay a lot less interest on a bond that I started now than I started 20 years ago.
Yeah. The reason we have high interest rates right now is it's the main tool and almost the only tool that the Reserve Bank has to control inflation. If inflation is under control, that means the Reserve Bank can start to cut interest rates. If they cut interest rates, that means that you and I pay less on our debts. It also means the whole country pays less on its debts because we as a country, we issue a government bond. We have to be attractive to everybody, South African and global investors, to offer them a good interest rate above inflation. So if our inflation rate is low, and that means instead of issuing a bond at 11%, we might issue it at 8%. Still a very attractive rate for investors above inflation. But you and I are spending less on debt, which means hopefully that we pay our debts down, and that means that we've got more money to spend on the economy, in the economy. So on building houses, all of those things. Lower interest rates are extremely positive for the property market, for every individual who owns a property or wants to own a property. Also for, unfortunately, things like extra spending. So now people will spend more on the things that they don't really need, but it's actually positive for the economy if we're not spending it on useless things. So we can actually create a positive economic spiral that causes better unemployment. You get the picture.
Okay, so then all of these things mean that there would be quite a lot of positive news over the long term because this is where the long term matters. But it's good news for businesses too if they want to borrow money to expand.
Yeah. So when you're paying 10 or 11% a year to grow your factory or to build a new building, 10 or 11% a year, most businesses would be thrilled to grow their whole business by, let's say, 15% a year. When you're giving away most of that just in interest, it just doesn't create scope to really invest properly. But if you're borrowing at 8%, it creates more scope to actually grow and grow. And that's what we want. We want businesses to grow so they employ more people. So lower interest rates caused by controlled inflation have a huge economic impact, but not tomorrow. So it's something that sustainably, incrementally causes the tide to turn.
You spoke about ratings agencies. Now, presumably they see this. If they then give us another, and going into this with S&P Global, they gave us the upgrade. The others haven't yet. But there was a lot of speculation. They didn't give us one now. They would give us one next year.
Yeah.
So they gave us one now. That doesn't necessarily mean they'll give us another one next year, but the others will sit up and take notice of that. What happens then if they all follow and we start slowly getting rated up?
Let's say, which is not unrealistic. I'm not saying we'll jump from 3 levels or 2 levels below junk to immediately in February. Now we're at investment grade, but that path to getting to investment grade is much shorter now than it was in the past. If we get to investment grade, that means we get onto global bond market indices, we get onto global stock market indices again, et cetera, et cetera. So now we start to attract money simply because of momentum. Back to the M word again. Momentum is in our favor here. So we get onto a whole lot of radars of the bond fund managers as well. And just global investors would be looking at this and saying, okay, you're investment grade. So if I'm a global manager and I've got to allocate money to places, I don't really get fired when I allocate money to an investment grade country. Allocate money to a junk status country and it doesn't go well, I get fired. So your risk appetite improves when you're buying investment grade countries. There's a lot of human behavior behind this. And then global businesses would be saying, okay, we can build factories there. We can build our operations down there as well. So investment grade for us is a huge thing. Like that's the thing we're really aiming for.
Okay. I remember the terrible headlines, South Africa now junk, when it all happened in 2017 and 2015 in December and all of that. All of this then, if we get some economic growth, it starts to spiral. What happens then? That obviously does things for the JSE, which is having a record time, even though a lot of the stocks that are doing very well are kind of earning money in dollars and are related to gold.
Yeah, so let's talk about the growth. Everybody's kind of forecasting that the country generates 0.9 or 1.1% economic growth. They call it GDP growth. If we get something slightly faster than that, where the good news does compound slightly, that means we start to absorb more and more people who are unemployed into the employment sector. Our population growth is not much more than 1 or 2%. So if you're actually absorbing people into the employment, where you're growing employment faster than your population is growing, all of a sudden, the whole country gets a little bit richer per person. So that's GDP per capita. That's the jargon. That is the golden, like the holy grail of everything. You want to get to that point where you start to make everybody feel a bit richer every day and that they see hope. What we know is if you have hope, all of a sudden you start to invest better and you do look at the long term. You do build a house, you do build a business, you do educate your kids in the country. So you break that really bad spiral that we might be coming out of now.
And that will also partly come over time because of a lower inflation target, because the interest rates in the end will be lower.
Yeah, I mean, I didn't appreciate, I had to spend some time with bond managers to understand that this inflation target, almost like the announcement of it, on its own wasn't something, but now the Treasury is agreeing and the Reserve Bank agreeing, and actually that people see we're sticking to it in our budgets and the way we're doing things, means that immediately, almost the very next day, when we issue new bonds or we're refinancing as a country, we're paying less interest already. So it had a very positive impact. We are not going to spend as much on interest as we have in the past, which means we can pay down our debt faster, which hopefully means we can invest as a country in more infrastructure, the things that create jobs.
Well, your questions for Warren Ingram tonight. John, I do see your call. We'll be with you in just a moment. First, Warren, Tony's asking, I'm changing jobs, have some money in my Provident Fund. I can draw a chunk of it as a resignation benefit. I have some credit card debt. Should I use my Provident Fund money to settle the debt?
I mean, I really don't like that as an option. I think, you do that when you've just run out of all other runway. So when you're cancelling or taking money out of your Provident Fund, you're paying big taxes on that. So you're already going backwards, and those taxes are probably higher than what the interest is that you'd pay. And all the growth that would have been in your Provident Fund growing tax-free, now you lose that. So you lose the tax-free growth and you pay a lump sum tax. So I think unless you're going to lose all your assets because you're going to be foreclosed or something, they're going to bankrupt you, the credit card company. If you can find another way, please do that.
Okay, so just keep the money in the Provident Fund, Tony. Over the longer term, it'll be worthwhile. All right, John on the line from Craighall Park. John, good evening. What's your question? Go for it.
Yeah, good evening. I've heard all of the advantages of a lower interest rate. What is the disadvantage, or why don't they set the inflation target as zero?
It's a great question, eh?
At zero.
Yeah, thank you.
All right, thanks, John. He's going to listen on the radio, Warren. Yeah.
John, your example is probably Japan, actually, because you do want a little bit of inflation because it's a sign of a growing economy. When you have zero inflation, you open the option for deflation, where for example, things constantly get cheaper. So that sounds like an amazing thing. But if things are getting cheaper, it means companies are making less money. It means they've got less money to pay salaries. They've got less money to invest in the country, the company. Everything goes south. So you actually want a little bit of inflation, but it needs to be under control and it needs to be reasonably small and reasonably stable. Then all of a sudden you get this positive spiral. But a zero inflation rate, I know it sounds good for most of us who don't want our food prices to get higher, but actually you want a sign of growth. You want things to get better and bigger. And I'm talking about economics now. And so a little bit of inflation is kind of your perfect point. 2 or 3% is ideal. That's what most of the good developed countries have.
An important conversation there with Warren Ingram on personal finance this week, looking at how you and investors can take advantage of some of our emerging economic optimism and look at what sectors are moving and how to benefit from hopefully an economic upswing.
702. The best of the Money Show from this week.
This week on How I Make My Money, Marelize van Zyl, the CEO of Aspire Art, looking at the intersection of art, culture, design and investment, and the work she does, making sure that you get value from your art.
So way back then when I went to university, I went and studied art. I always knew I wanted to somehow be involved with art, but not knowing exactly what to do. Back then, we didn't know about all the opportunities that can and do exist. And the art industry and market has also changed quite a lot. There are a lot more job opportunities. So many of us as art students, we would end up in other creative jobs like advertising or design or TV production and so forth. But yes, I ended up at an advertising agency, which was a valuable learning curve for me. I learned about business, project management, client relationships, But art was always my passion, and I was always looking for an opportunity to somehow get into the industry.
Okay, so you're now in the industry, and how did you do that? I mean, this is always the question. There's sort of the way in, because it's quite niche. We've spoken to one or two people in your industry before. We've spoken to an auctioneer, for example. She studied fine art and kind of went from there. But to get into it, how are you able to do that? Because I presume you can't just go from advertising to setting up your own business as you did.
No. It is quite a long process. But in 2007, I had an opportunity to literally pull a 360 on my own life and continue postgraduate studies, and literally just quit my job, moved to Cape Town, and finished studies. But it was while I was at university, I was introduced through my professor to this one gallery owner. And then I got a job as a gallery manager or gallery curator, they called it back then, to work in this commercial gallery and to literally start the business from the ground up. So it was definitely by way of introduction. And the rest is just a lot of hard work. Yes, introduction is important.
Okay, so, I mean, you're now in the space where you particularly look at art as an investment, as I understand it. And let me start at the beginning with this, because this is quite a complicated topic. I mean, there's a wonderful phrase, there's a wonderful philosophical question, what is art, right? So you could say art is a squiggly drawing. Art is the design of a really good cell phone. Art is a tennis racket. But we think of art as something that exists only for itself. So what then creates value in an artwork?
You know, that is actually what also put me on this path because I, while I was still at university, went to my first art auction. And back then also I loved reading the newspapers, and they would have these clips or photographs of paintings that went for a certain amount of money at an auction, be that overseas. And I always wondered, but how is this value created? And then when I pursued my postgraduate studies, it was actually the theme of my thesis, the creation of value in art, looking at auctions specifically. So it's quite interesting that everything came full circle for me, and now I'm working in the industry. But we work with fine art. So basically it's painting, sculpture, photographs, and new media work. And there is actually a clear set of indicators that we use to create that value. First of all, it's the artist, the position of the artist in the industry and what that artist does. Also, if we look at historical works, what was their role in bringing new ideas or methods to the fore. And then it's size. You know, you look at the basic things like size, your medium, and then the age of creation, and then also subject matter. And then the real thing that's quite, I think, difficult for a lot of people to understand, we also look at aesthetics. So we basically judge a work, you know, if it's good or not. They do always say art is in the eye of the beholder, but for us who have spent many, many years looking at art and studying it, we make those aesthetic judgments as well. So yes, we will stand in front of a painting and say, is it a good painting or is it a less, you know, accomplished painting?
So I would like to think that you and, say, your greatest competitor, if there were such a person, would be invited to a gallery and asked, so look at this, invited to look at an artwork. Do you think that you and someone else in your business would agree or disagree on whether something is a good artwork or not? What I'm trying to get to, I suppose, is there a commonality? Because without the commonality, there can be no extra value.
Yeah. So yes, absolutely. We would to a certain point agree on the value of that work. There is commonality, and that is also what investors look for or collectors. So it's a lot of talking, a lot of looking, but it's exactly those components of value: the artist, the date, the medium, the size, and then it's aesthetic factors. And then also we look at the market, we will see, okay, certain artists 10 years ago sold for this amount of money. What is the worth of that particular work now? And there are different indexes that we follow. We follow Mutual Art, Art Price, ArtNet, and these are all databases that literally they draw all the information and all the auction results. So you can basically do a search on a particular artist and then put in certain dates and mediums and subject matters. So yes, there's definitely a commonality.
Okay, so now let's get to a different thing. Who says? Okay, so why Now I realize you've studied this and I haven't, but why with something like this is your does it matter? Why is your voice louder than mine? Now let me just accept firstly that it should be okay, but I can't tell you why. But I mean, it's such a sort of childish way of asking it. But why do these people's voices matter and not others?
So because we work in it, this is our job. We consult people on it. My title, yes, I am a CEO, but first and foremost, I'm a art historian and a specialist. So it's the same way people review books or review movies, films, concerts, music. It's the same. We've studied it for so long and we follow it. It's actually for us quite close to religion. But the art world or the art market is not a new thing. It existed since the Renaissance, and prominent families like the Medicis, they all collected art, and then you will have their advisors as well. So yes, it's a very close-knit community. It's what we call the ecosystem. It is an industry that supports all the various role players, but definitely there are gatekeepers, but they always say the taste makers. But then generally there's just good art and less good art, and art that will give you a return on your investment.
So can you see, if you look at the sort of, did you say tastemakers, I think was the phrase?
Yes,
that as tastemakers change and say, for example, a particular group is in the ascendancy, they're starting to rise, can you then predict from that certain types of art will become more valuable and others less valuable?
Yes, absolutely. So we see that the industry and the market is it works in cycles. So you are not necessarily going to collect or appreciate the works or the art that your parents or grandparents collected. We do see the younger people coming in now. You see people in their early, let's say late 20s, early 30s. They have some disposable capital. They at an aspirational phase in their life. And so they are also looking to the finer things in life. And we see them starting to buy art. And then we see them engaging in our online auctions because naturally that's a medium or a channel that they really like and engage with. So they bid a lot online. And then it's also entry-level works. And I think they also enjoy that. And then we actually guide them through the process. So the road that we walk with collectors is quite a long one. I mean, I've worked with some collectors for almost 20 years, starting their collections, growing their collections, and then selling and buying again from their collections. But yes, definitely there are cycles, and we can see trends. And also an interesting thing for South Africa about 10 years ago, with all the new museums coming up in Cape Town, there was this big focus on contemporary African art and also the works from South Africa. And there also we saw a lot of figurative works coming in, a lot of performative works coming in, especially from international audiences that really loved collecting these works. But then again, we also see now there's older artists like a Frans Oerder, where you get people my age returning to those works and appreciating them more.
A conversation there with Marelize van Zyl, leading an art organization that's all about value and art.
702. You are listening to The Money Show's best bits.
Business Unusual this week, Graeme Codrington, the lead researcher at the Tomorrow Today Futures Institute. He was at the 2025 Dubai Futures Summit. He spoke about how focus is the new currency and also how you need to have deliberate attention for effective leadership. It's a fascinating conversation. Here's Graeme.
It is one of the highlights of my year, I'll be honest. Dubai is one of the only countries in the world that actually has a futures department in their government, and they have a cabinet member who is responsible for the future, Minister of the Future. And they invite the world's futurists to come and join them at that wonderful Museum of the Future in Dubai. And we spend a few days thinking about the future, looking at scenarios, and then the Dubai government produces a report, which they very generously make freely available. People can just do a search for it. This year's conference was held last week, and the report will come out early next year. But right at the beginning of the conference, one of the best sessions was actually by the chair of the Futures Foundation of Dubai. And instead of coming up with a list of predictions for the future, I mean, as futurists, we don't predict the future anyway. Nobody can do that. But instead of having a list of things that might happen in the next year or two, he brought out these 3 deep shifts that he believes is happening. And you're exactly right. The first one is focus is the new currency. That attention, our ability to obviously grab attention of the market, our ability to grab our own attention and focus it, whether that's on the to-do list in front of us or the work that needs to be done or the project we're trying to complete, or if it's just about making sure that our teams and our organizations are meaningfully directing their attention at the things that really matter. In a world of infinite inputs, protecting your focus is, I actually think, a key leadership skill, if nothing else. So I think he's right. And I think there's a lot of us maybe need to take some of the December break, not just to recover from the year, but to think about how we go into 2026 with a renewed attempt to focus.
It's so interesting because, I mean, so many things happen in a day. If someone asks me at the end, what did you do today? It actually gets quite hard to work out simply because you've done so many different things. And I'm sure it's the same for you. At
a personal level, this applies for sure. That I just think we can get into this. It's more than a hamster wheel because it isn't just about activity. It's about the scatteredness of what happens. And every time you dip into the news, I mean, there's 100 things going on at warp speed. But I think at an organizational level, I really do get a sense that people are not just sort of exhausted in the way you're normally exhausted in the last week of November. But I think we worn out by just this infinite change going on all around us. And we've got to almost get a systems level change in 2026. I think it's a good call to say, how do you get attention and focus and build it into your own life and your organization?
We're almost hyper-connected in a way. Another shift is that everyone and no one is an expert.
I like this one. I've used the line for a few years in my presentations where nobody is allowed to say, I don't know anymore. You can only say, I don't know yet. Or you can say, I don't know and I don't care to know, which is maybe one way to get your focus back. But we live in a world where any information, insight is available at your fingertips. AI pretends to have intelligence and give us even more information than we think. So at that level, everybody has the potential to have access to every piece of information and therefore can at least pretend or think that they are experts. On the other hand, there's a danger then that nobody is an expert. And I think we see this in the world around us, where there is now a sense that people are questioning everything. They don't know who to believe. That a video comes across your news feed, you can't be sure that that's real rather than just AI. And so there's a deep skepticism building. I think as a journalist and doing what you do, Stephen, this must be very concerning. How do we overcome this? And again, no answers, just questions. This is one of the defining shifts of our age. And in the next 2 or 3 years, I think is going to define our world quite dramatically. Everyone and no one is an expert right now. I think that's spot on.
And a little bit of information is a dangerous thing. And AI is reshaping trust and connection.
Now, this one was fascinating, and this one was where I took a little bit of a jump, because the actual way that the director of the Dubai Futures Forum phrased this is, AI will be your best friend. And I'm a little bit skeptical about AI. Not that it isn't powerful, but it isn't intelligent, in my opinion. It's a mimicry of intelligence, and I think it's best understood as a form of machine intelligence rather than a form of artificial human intelligence. But there are many, many people, and on our team, we have a psychologist who does quite a lot of work on trying to understand this. There are many people who are beginning to see large language models and AI models as people, as somebody you can have a conversation with, that you can interact with, that you can be friends with, even so far as to say, I would say, you could fall in love with. And I think that there's a fascinating thing going on here. I don't want to be judgmental in the way I frame it, because we have an epidemic of loneliness. There's difficulties with mental health. And I think if any tool that would be useful to help us deal with loneliness and mental health issues would be good tools. And I think there is some good to be done there. But I think there's also danger down that path where we replace real human interaction with human machine interaction and no guardrails around it. So for me, the response is that we need to become more bionic rather than automate the world. We must augment the world where human and machine sort of work alongside each other rather than replace each other. But I think it's a fascinating thought that maybe the next step for AI is a step into the relationship space rather than just the business automation space. Fascinating.
Graeme Codrington there on Business Unusual, giving an update and a breakdown of what was spoken about at the Dubai Futures Summit.
702. The best of the Money Show from this week.
You've been listening to the best bits of The Money Show, a digest of just some of the best interviews from the show this week. If you'd like to hear more, go to our website or your podcast app and search for The Money Show. Thanks for listening. We'll be back on The Money Show, 6 p.m. on Monday. Have a good weekend.